All right, everybody, welcome back to Matt Money. We are here with Will Rhind, the founder and CEO of Granite Shares. It's an ETF company. Will, do us a favor and introduce yourself and what exactly Granite Shares is a little bit about.
Yeah, no problem. Thanks, Matt. First of all, thank you for having me. So I'm Will Rhind, founder and CEO of Granite Shares ETFs. And Granite Shares is an ETF issuer, which means that we're an asset manager that specializes in issuing, managing, distributing a specific type of fund called an exchange-traded fund or an ETF. So we do that here in the US, headquartered out of New York City, and in Europe, where we're active on all the major European markets, with distribution also into Asia as well. So we're a global company, but the key is focusing on manufacturing, distributing ETFs.
Yeah, you guys have been around for quite some time, almost 10 years about, but some of your ETFs are even longer than that. Specifically like the commodities one. I know gold was a big one for you guys starting out, but really you guys have ventured into the leveraged ETFs. Any particular reason why? Is there just a lot of support coming from the consumer that really is kind of enabling that, or is there a broader strategy behind that?
Yeah, I think when you're in a business like ours, it's a product or an ideas-based business at the heart. So you're trying to create new products that investors want or the market wants, and sometimes it's difficult to find white space in the market because there are so many different financial products out there, and it's sometimes it's difficult to see necessarily where there are those gaps in the market. But we certainly identified leverage on single stocks as being one of those white spaces in the market that no one had done. And we'd had some prior experience with a previous company doing leverage on commodities, so providing leverage 2x, 3x, etc. strategies on oil, gold, etc. And those have been very popular. And so the natural extension was to say, okay, well, if people want to do a leverage play on oil or gold or nickel, tin, etc., then why would they not want to do that on stocks? And arguably, that's the more kind of intuitive expression of that, because if people are going to margin via traditional margin accounts, they're most likely margining stock positions. So therefore, the idea was born to create levered single stocks, which are obviously ETFs that provide a fixed amount of leverage to stocks. So for example, 2x NVIDIA, giving 2 times return or 200% return of NVIDIA over a given day. But what they also are is products that give institutionally priced leverage, in other words, lower cost leverage and without margin. So it's a really sort of interesting product that solves a kind of market access problem as well as gives investors access to something unique. And that's been a huge success story for us. And this has grown significantly. And what's interesting about a product like this is it's a global product, so it captures attention from people all around the world. Because regardless of whether you're in Taiwan or whether you're in South America, there's only one NVIDIA, and that's first and foremost trading in the US market. And then when it comes to 2x NVIDIA, our NVDL is the largest single stock ETF in the world. And people are getting that from all over the place.
Yeah, it's up to like I looked the other day, like 4 billion in terms of AUM. It was pretty interesting to kind of see that. One that's actually hit our channel that a lot of people are talking about is the Palantir 2x leverage. So that just came out, and so we've been following Palantir on my channel since like the direct listing day. I actually use the product at my 9-to-5 job as well, and so people have been chirping up about it, and I was like, well, that's interesting because I'm literally going to be having a conversation with Will. So congratulations on that one. Hopefully it continues to succeed for you.
Yeah, no, I mean, it sort of reminds me a little bit of NVIDIA in the sense that we launched NVIDIA, way before anybody else was really focused on it. And then we had the release of ChatGPT, and it really sort of brought NVIDIA right to the forefront of everybody's thinking. And our 2x NVIDIA really took off from there. And I just wonder if we'll see a similar thing with Palantir, where clearly we launched the ETF, and then as of last Friday, Palantir goes into the S&P 500 and is now just going to have way more visibility than it's ever done before. Clearly, the stocks perform very well, but it ticks those kind of right boxes in terms of AI exposure, and the super growth.
Yeah, it's definitely one I'm going to be holding on for the long term. Might see some volatility in the short term. It is a little overvalued right now, but we'll see. Long term, it's a great opportunity. So one of the things that I think people are interested in is they hear that these sorts of leveraged ETFs shouldn't be held for long periods of time due to the fact that they might not necessarily truly be 2x or 3x over the course of 6 months to a year. They claim that they have some sort of drag or there's some fees associated with the investment that causes that. Can you give us a little bit of explanation as to how that may or may not be true?
Yeah, sure, Matt. I'm happy to. So the good news is it's not the fees. The most important element, clearly there are fees involved, but it's very small in the grand scheme of things. The biggest impact on the return is the way that the actual return profile is generated. And put simply, what's happening is that the funds are designed to give 2x exposure to a given stock, let's say, or minus 2x, whatever the leverage factor may be, over a given day. And that's called constant leverage. So the idea is that whenever you buy, it doesn't matter when you buy, when you sell, you'll always be getting the stated leverage factor, the 2x, whatever it may be. So the way that that happens is at the end of the trading day, that portfolio was rebalanced. So that's rebalanced to take account for the market movement on that day, plus or minus, obviously, any inflows, etc., into the fund or outflows from the fund. And then that is rebalanced. And then at the beginning of the next trading day, the 2x leverage is obviously applied on that particular position. So because it rebalances every day, that's called a path-dependent return, which is different from a linear return. So for example, if you held NVDL for a year, as an example, so you held from the beginning of the year to the end of the year, and you also were comparing that against NVIDIA stock, and NVIDIA stock was up 100% for the year, NVDL almost certainly will not be up 200%. It will be either more or less. And the reason for that is according to the path dependency, i.e. what path that stock took during the course of the year, the ups and the downs. And when you're rebalancing, it creates a compounding effect. And the compounding effect, in very simplistic terms, means that you're typically going to outperform the 2x linear return on the stock in a trending environment. So in other words, if the price of NVIDIA is going up, day after day, you're compounding those returns leading to outperformance. If it's going down day after day and you're long, you're going to, of course, underperform. And then the bit that probably confuses people the most is where you have a flat or choppy environment, and that's where the stock is going up and down and up and down and up and down. And the reason why that causes NAV erosion is kind of based around the concept of the stock or the market drops by 50%, that if it recovers 50%, you're not break even. It has to recover 100% to break even. So it's this idea that you're sort of buying high and selling low. And that's probably the environment that the ETF doesn't like because it's rebalancing daily. And that effect is called compounding or path dependency. You'll see it named different things online. But what it means is the most important thing is there's a different return profile than a linear return. And of course, there's always like a pro and a con, right? The con is sometimes portrayed as over long periods of time that you don't get exactly what you would get if it was on a linear return. The pro is that you never have to worry about margin. And if you're trying to do that on a leveraged linear return, you always have to worry about margin calls. And typically, a lot of times, people lose money, not because they were wrong in terms of the direction of the stock, but because they couldn't hold the position due to margin calls. And so there's always that sort of, for every sort of pro, there's a con, and every con there's a pro. And so there's a trade-off. If you want to own this product, you're in control, the broker's not in control, and you're in control because there's no margin.
Yeah. No, that's really good feedback, because I've noticed in my own, I take a small percentage of my portfolio and I invest in ProShares TQQQ, which is a triple leverage NASDAQ 100. And when the market's on a roll, that thing is moving, over the course of a week or a month, that thing can move way more than 3x, right?
That's right.
Like you said, it's really compounding on a day-to-day basis. So it's 3% one day, then it's 3% the next, and in actuality, it's moving much, much faster
Right.
because you're resetting every day. But the same effect happens when you have large pullbacks.
Yes.
Where so it's almost like you said, a pro and a con, depending on what you're just talking about. Can you explain a little bit how that might be different from what you might experience with like a futures ETF or like a double leverage futures ETF? Because I feel like there's also a little bit of a difference where with that you also have the actual price of the futures contract, so you have to take into consideration that might, I don't know if this is the right term, but might also have a drag on the potential performance, right? So even though you're seeing it go up and to the right a little bit, you're actually staying rather flat for some of these opportunities, depending on how quickly it moves. Very similar to what you talked about. If you're going up very quickly and go 10% in a week or a month or something like that, you will see that movement in the underlying. But if you're talking about, or not the underlying, but the actual ETF, but if you're going up 10% over the course of a year, it might not actually move the ETF at all. So can you explain if there is a difference in there, or are they exactly the same?
Yeah, so there is a difference. And the difference is that it's not in the way that the ETF works, because it works in the same way. All leveraged ETFs work the same way, which is they rebalance on a daily basis. And so that element, the compounding element, will be present in every leveraged ETF, regardless of, like you said, whether it's a TQQQ or whether it's an NVDL. What you also have to account for is if it's a futures-backed product. Futures have a phenomenon called contango backwardation in them, which in other words, futures contracts are subject to a curve. And depending on, like, for example, the commodities, that curve kind of reflects the supply and demand, the storage, and the financing costs. And so typically when a commodity is in contango, which means that price on the forward curve is higher in the future than the spot price today, what that means is when you roll that futures contract, in other words, you buy the contract that's closest to expiry, so that might be this month, for example, or the next month, closest to the spot price. When you have to roll it, rolling is just another word for you've got to sell that contract and then buy the next one. Otherwise, you don't want to let that expire and take delivery of a lot of live capital or something like that. So when you do that, you're again selling the contract, but you're paying a higher price for the same amount of exposure. So in other words, you're eroding your return. And so that's just another thing to bear in mind when you buy products of futures. Clearly, stocks don't have that phenomenon. There's no such thing as contango or backwardation in equities, but in futures market there is. And so it's a function of financing and supply and demand for a given commodity, or a given contract at any given time. And again, people just have to understand that what that is, and then how that potentially can affect returns, in addition to the compounding.
No, that's really helpful, because I think a lot of people have gotten exposure to these leveraged products, mostly starting with oil ETFs or with commodities ETFs, and it's really become more popular for the stocks. And so I think that, like you said, it seems to be exacerbated with some of those commodity ETFs due to the fact that you have the futures aspect of those contracts. And it seems like
the other thing, Matt, is that it's a nuance as well. But I think the other thing that I hear or have seen over the years is that, especially when it comes to commodity futures, I think sometimes there's a misconception that people are buying the spot price. They're not buying something that is based on a futures price, which is typically 1 month more away from the spot. So when people look at, say, the price of oil, and they're looking at the spot price of oil, and then they look at the oil futures product and say, oh, the spot price of oil is up 10%. Why is my futures product doing something different? Not necessarily understanding that it's two different prices that they're looking at.
Yeah, no, 100%. I mean, I work in oil and gas myself, so I recognize that the likely USO is probably trading on October right now.
Exactly.
Yeah. So I know you guys had put up for a Bitcoin ETF, but I think eventually you guys never ended up following through. Could you explain what happened with that?
Yeah. So I guess back in the day, we always try and do something first, or be the first to market, especially on something unique like Bitcoin. And when we filed originally, back in 2018, we thought that we had a good chance of being the first Bitcoin ETF here in the States. And then when the regulator sort of shut that down fairly early on and rejected the applications, we sort of realized the broader implication that it was going to take years before the first Bitcoin ETF was going to come out. So as a growth company, kind of at that stage, we just decided to prioritize other things rather than sort of fight the good fight on the regulatory side around getting that product pushed through. So we went in a different direction, and in terms of how we think about crypto after that, we decided to kind of express that in the form of the leveraged single stocks we bought out on companies like Coinbase. So we have a 2x long Coinbase at Cornell, and we have a -1 times short, so an inverse Coinbase, CONI or CONI. And that's some of the way that we've kind of preferred to go about it, which in hindsight is probably a good decision because, as we all know, the Bitcoin ETF market ended up being completely overhyped, and tons of issuers got into the market, and after that, the Ethereum ones haven't really taken off in the same way. So I think it was a good decision for us to go in a different direction and provide something unique as opposed to just bringing out a bunch of Me Too products that we've seen in the space since then.
No, that's a good way. Yeah, I've studied some of I've been in Grayscale for quite some time, and that was kind of a trust before it was a spot ETF. And I've recognized the space has kind of slowed down, I think, and maybe it'll slowly grow over time. But it's really like 60 odd billion in terms of the 11 or 12 different ETFs that are in there. So I can recognize the competitiveness of associated with that, but also the opportunity, for the uniqueness of those leverage ETFs can definitely pose a better business opportunity for you guys. So I know you have a bunch of other different products as well. You have more than just the leverage ETFs. I know you have commodities, you have equities, you have income. So you want to touch a little bit on those so everyone gets a full picture as to what Granite Shares offers.
No, absolutely. So outside of the leveraged ETFs, in terms of our non-leveraged or unleveraged ETF suite, we have gold ETF. BAR is the ticker, BAR, where we hold literally physical bars of gold in a vault. We have a physical platinum ETF where we hold, again, physical platinum in a vault. That's our PLTM. And then we have COMB or COMB, which is our broad commodity ETF. And that holds a suite of commodity futures. The most liquid, most economically significant commodities in the world. There's 23 of them. Ranging from oil to metals to grains to livestock. And that is based on an index called the Bloomberg Commodity Index. It's probably the most well-known or the most famous commodity index out there. Sort of if you were imagine an S&P 500 of the commodity world, that would be it. And then outside of commodities, we have a income product called HIPS, and HIPS stands for High Income Pass-Through Securities. And HIPS distributes about just over 10% per annum in terms of yield, and does that on a fixed monthly basis. So distributes a fixed cash amount or amount every month. And therefore, depending on when you buy it, you lock into that particular yield based upon the fixed cash distribution. And then lastly, we've got our DRUP ETF, stands or short for disruption. That is based upon an index created by the NASDAQ called NASDAQ Select Disruptors. The idea behind this strategy is to try and invest in the 50 or the top 50 most disruptive companies in the US, and that's as measured by NASDAQ. And so we take the top 500 companies by market cap, score all those companies, and then we bound the portfolio or position the portfolio in terms of the top 50 that have the highest scores, and then that becomes, or those become, the top 50 disruptors.
Those are pretty unique. Yeah, I'm kind of curious. I need to do a little bit more due diligence on the income one as well as the disruptor one. That sounds pretty interesting. Are there any other particular avenues that you plan on opening up? I know some people about a year or two ago were really infatuated with the covered call ETFs, whether it was on an index or whether it was on a specific stock like Tesla or Coinbase or what have you. curious if that's an avenue you guys might take, or where else other ETFs or blank spaces that you see in the market at the moment that you guys might be adding services to.
Yeah, I mean that's an interesting area of the market. It's clearly been popular. I think people are just looking for income and particularly large amounts of income. So we actually have a filing currently in with the SEC under the brand name Yield Boost, or sub brand name, it's clearly Granite shares, but calling it Yield Boost, and that's for a suite of income-based ETFs using options. So because that's in filing at the moment, I can't say more than that, but kind of watch this space. And if you like ETFs with income and like ETFs with options, it's something to keep an eye on.
Interesting. Yeah, that's. I know some people are really in love with that. I prefer sometimes the 50-50 ones, the ones that are 50% uncapped, 50% capped, and they write the covered calls on it. So you get a little bit of both the growth as well as the income from those. In terms of where you guys are going, you said you're in Europe, you said you're in Asia, you have a plethora of different products that are already out there. 5 years down the road, what do you see Granite Shares doing that they aren't doing now? Is it different ETFs? Is it continuing to find the new hot markets? Where do you see it?
Yeah, I mean it's a combination, I think, of new products, which is finding new areas to go into. I think there's plenty of growth in the leveraged single stock business. Clearly, that's a scalable one. That's where we're seeing a ton of demand. There's growth there. There's growth in the options income side, or just the income side. And then I think there's also growth in sort of unique ideas of all varieties. It could be commodity ideas. It could be equity or fixed income. So product side, lots of room for growth, and then geographically, lots of room for growth. So we've mentioned Asia, but that's just starting in terms of people getting exposure to the ETFs and the kind of the ETF revolution, if you want to call it that, that's happening all around the world. So some markets, clearly are much more advanced than others, but there's some big opportunities out there that we're going to tap into both geographically and in terms of new products.
No, that's really cool. One last question for you. If somebody out there says, "Hey, I really like this stock. I want to double or triple leverage or short it, right, by 1x or something like that," how do they reach out to your team to make sure that they potentially might get it on the market?
Yeah, so the easiest way is to contact us directly. So through graniteshares.com, which is our website. We have different ways to get in contact with us. If people like to chat, there's a chat function. If people like to call, there's call, or people like to send an old-fashioned email, there's that as well. So multiple ways to do it. There's a ton of information online, not just our website, but through all sorts of other kind of publications, well-known, credible publications that are written on the subject. So, advise everybody to do their homework as usual, and learn as much as you can about the product, and then any questions clearly come to us directly.
Cool. Well, Will, I appreciate you spending some time with me, and hopefully we can have you on the channel again soon if you release any new products.
Thanks, Matt. It's been my pleasure. Thanks so much for having me.
Yeah, absolutely. Thank you.